So I'm here joined by James Lang from Greenberg Traurig, very adept and experienced in opportunity zones for quite a long time. Jim, why don't you give us a little background around your experience and your track record here with op zones, and then we'll just dive right in.
No, absolutely. So I'm a tax credit tax incentives lawyer, as most of my team is. And that traditionally has meant the major tax credit programs. So low income housing tax credits for affordable, historic rehabilitation tax credits, renewable energy, both ITC, PTC, some of the transferability now, and then all the other types of technologies, including carbon sequestration. And we always had a sub focus in state and federal new markets tax credits, and a outgrowth of that, or a kissing cousin to that, was the QOZ incentive. And we've been watching it for many years before it was even a proposed legislation back in before 2017. And then Economic Innovation Group pushed it pretty hard. It was standalone, and then it was a late Senate amendment in the Tax Cuts and Jobs Act. We were very early because of that background. We were very early in that stage of still that in 2017, yelling from a mountaintop to our friends, clients, and colleagues, this is one of the most important tax incentives of the last 30 to 40 years. Because of that, we got involved early. We've now represented over $22 billion worth of qualified opportunity funds. We represent the largest aggregated qualified opportunity fund in the space, 6 of the top 15. Over 850 QOZB deployments in the industry, and over 450 of these quote unquote captive family office or high net worth qualified opportunity funds that are investing in deals, either their own or others. And we got a good team now. We've got 30 to 40 folks that work on this, lawyers that work on this on a regular basis. We've got 90 to 100 that touch it in one way or another. And then my core team does this 24/7. So we do a little bit more of this than probably anybody else in the country does, but we see everything out there. And we're certainly seeing 2.0. My days are now filled with 2.0 discussions, structurings. Everything is focused around both where 2.0 dollars are going to go, how we can bridge over to 2.0, and then what the tracks are going to look like, the transition between 1.0 and 2.0 tracks.
Great. Well, I'm grateful to have you here for our audience that is comprised of all different types of people, some savvy real estate investors and developers, but some of the general public that may know nothing about opportunity zones and why it is actually important. You know, there's a lot of acronyms that you threw out there, from LIHTC to this to that. And I think at the end of the day, you know, what people really want to know is, how is this going to impact them? And really, Opportunity Zone was intended to revitalize low income areas, 8,700 districts to be exact, through investment of capital gains. It was a tax incentive, which, as you said, was one of the most important tax incentives for driving investment into these underinvested areas. And in the first round of Opportunity Zones 1.0, it was largely focused on urban area. And it's my understanding that, you know, in Opportunity Zones 2.0, there's a big drive towards rural areas. And so what I'd like to do is, we've now had about 8 years of Opportunity Zones 1.0, and you've had a lot of expertise and deployed a lot, helped steward a lot of capital into these zones and these districts and these QOFs, these funds, as well as these businesses, which can be both for real estate, but also for operating businesses, so that people understand that it's not just real estate. I think that's a misinformation or misunderstanding around the program. And I think that's one of the tweaks in 2.0, is getting people to understand that you can invest in businesses in the district. What do you think worked well in 1.0? Before we jump into 2.0, what do you think worked well in 1.0, and what do you think didn't work in 2.0 that is being solved or being improved upon in 2.0?
Well, in general, I think 1.0 was I would like to call 1.0 now a trial run of the incentive. And I think 1.0 was incredibly effective. It's pumped lots of needed private capital into areas that needed revitalization. Now, and it's created lots of jobs. It's done many of the impacts that it was intended to do, and that's why it was renewed. And in fact, not only renewed, made permanent in 2.0, which I'm sure we're going to talk about. But what are some of the downsides, and what are some things that I think 2.0 might fix here? I think some of the downside is we're getting more targeted in our qualified opportunity zones. So the zones that are actually going to get designated next round are probably the zones that really need the revitalization, and not when I say that, I don't mean the zones that are 20 to 30 years out. I'm talking about the zones that are right on the cusp, and this is an incentive that's going to push them over and be the right type of incentive to get private capital flowing into those communities. What you don't want either end of the spectrum. You don't want zones designated that are really no business or no real estate projects ever going to invest there. You also don't want the other end of the spectrum. You don't want the zones that we're giving a federal incentive for something that was already going to get done at the end of the day. We want those zones that are really going to push a community over the edge, and this is going to be the revitalization. And I think we're getting closer to that in 2.0, particularly when these new 2.0 zones are designated next year. I think both communities and the governors of the states are realizing that there's a great focus on where these should be. The other piece of it, and I think you touched on this a little bit, was real estate took over the industry. I mean, as it does and should, real estate is incredibly focused on tax incentives and knows how to use tax incentives for many, many decades as to how to take the best advantage of tax incentives. The operating business world is not as keyed into how to use tax incentives. And so we would like to see an uptick in operating businesses. And I think that both the law itself and the regulations that come out of the law are going to help support that. But we would like to see a greater mix between operating businesses and real estate using this incentive going forward. It was originally intended for operating businesses. That was the original intent, but behind the Economic Innovation Group, chaired by Sean Parker of Facebook and Napster fame, was to move new startup companies or companies starting new lines of businesses into areas that need economic revitalization rather than just starting it up in Silicon Valley.
Right. And that's the beauty about it, because it's kind of like the idea originated from the tech world, but it ended up benefiting the real estate world. But now it's coming back with a new 2.0 version that's much more incentivizing, and focused on businesses and in rural areas. And in terms of what people get from this benefit, both for the real estate and the business side, really let's talk about what is the motivation, what is the incentive for somebody to invest in a QOF or a QOZB? Why do it?
Right. So from an investor level, both the current incentive and the new incentive, the incentives are very similar. But the difference being 1.0 had an end date, and that end date is December 31 of 2026. So we always had this built-in end date coming on the incentive, and it was hard-coded for a lot of the different portions of the incentive. But the first incentive is you get to defer your taxes. Under 1.0, that meant until December 31 of 2026. And that still is the case. If you invest today and you don't use some other type of creative strategy, you're going to invest today and you're going to only defer for the next year or so, a little over a year, to a hard-coded date. Two, you might have, if you invested before 2019 or 2021, gotten it up to a 15% step up in basis off of your deferred tax. So both of those are great incentives, the deferral and the step up. But the real incentive in a QOZ setting is the post 10-year step up in basis. So if you invest, let's just say $1 million today, and eventually you sell your project for $10 million, the $9 million of appreciation will not be additionally taxed after 10 years upon your disposition. And more,
we're talking about capital gains.
Well, yes, your capital gains that you invest on the front end. So every investment into a qualified opportunity fund has to be eligible capital gains today that you get to defer. And then on your exit, when I say $1 million of capital gains that you defer today and you invest into a deal, then after 10 years, in my example, $10 million, that $9 million is not additionally taxed. And moreover, because it's a fair market value step up in basis, so you get to step that up to what the fair market value was on sale, you're not going to have depreciation recapture on the losses that you've taken along the way, which is incredibly valuable, particularly for real estate deals. But you can also imagine what that does to IRRs on operating businesses that are high appreciation on a post 10-year horizon, now your IRR on that project is incredibly valuable. If you've got a unicorn type of operating business or an operating business that does very high multiples, whereas real estate can do very good multiples, you're never going to see the type of multiples in real estate that you see in operating business.
Right. And that's the thing that I think people haven't realized in 1.0. You haven't heard those stories as much about the opportunity zone businesses, the unicorns that 10x, the 100x, et cetera. You hear it in real estate. And like, as you just pointed out, that step up in basis. So somebody invests $1 million, they get 9 million in appreciation. They pay zero tax on that. There isn't another program like that. And I think as an alternative before opportunity zones, most real estate investors would do 1031 tax-free exchange or a like-kind exchange. And just to differentiate these two programs, because people still ask me today, well, why wouldn't I just do a 1031 exchange? What is the difference between op zones and 1031, and why is one better than the other?
Well, I'm not going to say one's better than the other. They're great in their own situations, but the difference, I think, some of the major differences on why people are doing QOZ investment rather than 1031 is because, one, it's an exit strategy. In a 1031 world, you have to stay on a hamster wheel going from one 1031 deal to another. And until death, until that great basis step up in the sky. This is a way that you now have to exit that. And if you're a young enough investor that you still have a lot of timeline, that's very attractive, because now you get into a QOZ setting that can get you off of that hamster wheel, and you're still deferring your tax for a good period of time. Secondly, and I think very importantly, is that 1031 is only applicable to real estate. So going from one real estate deal to another real estate deal, whereas in a QOZ setting, your exits, your capital gain could be from a sale of a business, sale of stock, sale of collectibles, sale of whatever creates your capital gain for you. And moreover, you can invest into a real estate business, an operating business, or an adjacent type of a business that does both. So those are the types of businesses that are, say, hotels or sports teams, or many of the businesses that you do, Tony, that have both real estate and operating business components.
Yeah, I mean, it's a way more comprehensive program, and it doesn't only rely on capital gains from real estate or from proceeds from real estate. And again, what people need to understand about 1031 is you have a limited amount of time to identify and close on another property. And if you're in a high market, you sell high, guess what? You have to buy high. And so you're really not going to be opportunistic in what you're doing. Whereas with opportunity zones, you have the opportunity to invest in a business, you have the opportunity to invest in real estate, you have much more flexibility. Yes, you do need to hold it for 10 years, but I think in 2.0, there is some tweaks to that actually make it even more desirable than it was in 1.0. So let's start turning over to now 2.0 and talk about what are the major improvements or upgrades from 1.0 that we're going to see in 2.0.
So the greatest upgrades are, one, we now are permanent. This is perpetual and permanent. This is part of the code for, well, prospectively forever until Congress changes things again. But this is now a permanent part of the Internal Revenue Code. We don't have an end date. Right. We don't have an end date now. Gains that are realized at any point in time can get their 10-year clock going forward. So you can realize a gain in 2050, and you're going to have your 10-year clock to hold. Whereas under the current law, that was going to end December 31 of 2026, only gains realized before then. So that's the most important, is that we now, and that's important for several reasons. Obviously, it's important that we now have a permanent part of the code, but for fund sponsors, for investors, for developers, for operating businesses, and for professionals in the field, you now can devote the type of resources you need to devote to qualified opportunity zones that you weren't able to do before. And we're already seeing that. We're seeing that movement, particularly off of Wall Street, that groups that were not necessarily involved before are now getting involved, because with permanency, you're willing to devote those types of resources to it. Two is now we have a rolling 5-year deferral period. So we don't have that hard-coded date like December 31 of 2028, 2026, anymore. Now we have a rolling 5-year deferral period when you invest. Very important. Again, now we don't have diminishing value for investors, because in the last 2 years, that deferral value was almost nothing because you're only deferring for 1 to 2 years. Now we have a real deferral value, and you're always going to have your 5-year deferral. And hand in hand with that goes a 10% step up in basis, which again is perpetual. That as long as you hold your investment for 5 years, so even if you don't make it to your 10-year runway, you still can write 10% off of your tax if you hold for at least 5 years. And so you have a basis step up of 10%. And even more so, if you do a rural qualified opportunity fund that is investing in rural projects, that 10% becomes 30%, that's almost getting into tax credit type of numbers, because 30% is incredibly valuable in terms of making writing off of your tax that you have today.
Then you're starting to get into institutional fund territory. When you go down from 10 years to 5 years, that you get a step up and you actually get a benefit, that moves the needle, I think, for institutional investor, does it not?
I think that's true. I think that we're starting to see many more institutional investors get interested in this.
Right.
And if you look at what the rural areas could be in the next round, a lot of them are not the areas that you would necessarily think are rural. You could look at them and they're already in the path of development, or they're already in areas that we might think are urban sectors, but they're going to get rural designation.
Right. And what is the qualification for rural designation? Do we have any color on that?
We have a little bit, and we just got a little bit of guidance about 2 weeks ago. But in general, it's communities that are 50,000 people or less.
Okay.
But importantly, it's not based on metropolitan statistical area, because that encompasses a whole lot. Whereas this definition is more akin to the USDA definition of rural, and USDA definition areas that you can drive to outside of major cities. So I think we were just recently talking about Jacksonville. You can drive outside of Jacksonville very quickly and get into areas that are going to qualify here. Whereas if we used an MSA definition, we would have to go almost into the middle of North Florida to get into rural. Whereas here, you can drive 20 minutes outside of the urban core of Jacksonville, and you're going to be in an area that's rural.
So there's going to be a lot more areas designated as its qualified opportunity zones then, right? Then right now we have 8,700, so it's going to be much more significant.
No, it's actually going to be less under the current law, because they changed the definition from 80% down to 70% for AMI. So we're going to have less opportunity zones. We're probably going to have more rural opportunity zones.
Interesting.
But we're going to have a little bit less opportunity zones on whole. And a lot in the industry have thought that that's depressing, and on its face, maybe it is. But I'm still optimistic about that for 2 reasons. One, I think this is just the start. I think we're going to get a lot of add-on opportunity zones for a lot of different reasons. Some of that's going to be affordable housing. Some of that, I think, is going to be critical minerals. Some of it's going to be defense related projects. Some of that's going to be disaster relief. When disasters hit, we're going to use qualified opportunity zones. So I think we're going to get a lot of opportunity zone add-ons in the future. But in 2.0, we are going to have slightly less than we had in 1.0.
Oh, that's interesting. I didn't realize. And so how do you think that that's going to impact current people that have op zones today? We're going to lose some of those existing op zones, and that's going to be based on what is going to be the factor that it's going to be based on in the urban areas primarily.
Well, so the designation is based on 2 things. One is area and median income, and that's been dropped from the first designation from 80% to 70% now of AMI for census tracts. The second is a poverty rate, and that hasn't changed between the 2. But because of that AMI drop, we're going to see fewer zones eligible. And then the governors, starting on July 1st of 2026, are able to designate up to 25% of those eligible census tracts as the new census tracts that will have their new 10-year life going forward. The old census tracts, the ones that we have today and the ones we've been dealing with and are great right now, those will expire on December 31 of 2028. So there will be roughly a 2-year overlap between 1.0 tracts and 2.0 tracts. And we're asking Treasury, and I think we're getting good movement, although the government's shut down right now, on having transition rules for the 1.0 tracts, so that projects can be under development, can continue raising capital after December 31 of 2028, as long as they've made a certain threshold investment in the QOZB and are subject to a working capital safe harbor plan. But regardless, we're going to have a good period of time of overlap between 1.0 and 2.0 tracks.
Right. And so is there a risk? I mean, someone like me, I'm developing a large project in Jacksonville, all op zones. I've been in it now for 6 years. This program sunsets at the end of 2026, but you said that there's a gap until 2028. I won't be complete with all of my QOZB's development, my individual buildings. What is the likely, I actually think that we will qualify for the 70% AMI. We're in a low income area. So I don't think that's going to necessarily impact us, but it could theoretically. And what would that mean for a developer like myself in that
Yeah.
type of, that's in the middle of the project, hasn't fulfilled the 10 years yet to get the benefit? Obviously, it has a deadline, had a finite closing date. What happens? What is the
So,
likely scenario?
so the best answer, like you brought up, is the best answer is to get designated as a 2.0 zone, because now you have a 10-year runway. But let's say that doesn't happen, and now you're 1.0 zone with December 31, 2028. Under current law, without this transition guidance, we would suggest you have to get placed in service by December 31 of 2028 on your project. What we're asking for, and what I think just makes sense, and also what the entire industry agrees upon, these transition rules for those 1.0 zones, that as long as you've made, and right now under the draft comments to regulations that we've been participating in, that would be either the lesser of $250,000 or 10% of your overall budget at the end of the day under your working capital safe harbor plan. That second item is to make sure small projects are protected here, but in most cases it's going to be $250,000. That as long as you made that investment and you're subject to a working capital safe harbor plan, you can continue your development over 12/31 of 2028, and you can continue to raise QOF capital after 12/31 of 2028, subject to that working capital safe harbor plan.
Oh, okay, so that's not too egregious. That's pretty, I mean, especially in a project like ours. I mean, we're definitely going to be putting in a lot more capital than $250,000.
Right. Absolutely. Yes.
Interesting. Okay, awesome. And in terms of, so we talked about the permanence of the program now, which is a big deal. We talked about the step up in basis, which I think is a really and we talked about the 5-year deferral versus the 10-year, right? We talked about that in 2.0, the focus on rural, the change to 70% from 80% AMI. So there's actually going to be less districts with a focus in rural area. The guidance is under 50,000 population and not using MSA as a determinant of that, but the definition of, getting out of the urban core, basically, that, wouldn't eliminate places that are, I would say, urban adjacent rural areas, which I think is
Well,
important.
yeah, the funny thing about that is, and this is great for the development community. It's that this entire legislation was supposed to help rural QOZs, and it's going to very much help those adjacent rural QOZs that you just talked about, the ones that are near urban cores but are still meet the rural definition, where this is actually hurting in a major way. That it dropped from 80% to 70%, or the rural zones. So the very rural zones are hurt by that because they already have a much lower area median income, and by dropping from 80 to 70%, areas that you would think would be qualified in the middle of nowhere in some cases are not qualified now because of that change. And so in the rural, we're actually seeing, like you said, those urban adjacent rural areas that are going to meet the definition of rural are going to be some of the most attractive rural tracts, while some of these are just not going to qualify that you would think would easily qualify.
Interesting. Yeah, it's incredible how these incentives drive development, right? It's just the way that it happens. Like you see other projects, like in Florida, we have Live Local, right? Where you do a percentage of affordable housing and you can basically bypass the land use within a certain district. And you layer that on with Yes in God's Backyard and other legislative things that have come down that are really to encourage development in areas that haven't traditionally been invested in or developed, church properties, faith-based properties, rural areas, small businesses, which I think 2.0 really tries to address. So let's turn our attention for a second to the businesses. How do small businesses and how do businesses in general benefit from op zones and benefit from op zones 2.0, even in more enhanced perspective?
Well, two things. One, I think we're going to get much more regulatory relief that are going to still help businesses attract capital. But even without that, with 2.0 being perpetual now, some of this is an education game, because real estate understood this very well, and real estate took off with it, and real estate understands tax incentives. And traditionally, many operating businesses just don't use tax incentives the same way. And if they do, it's say 1202 qualified small business stock type of incentive. And this actually marries up pretty well with qualified small business stock. Many small businesses that we help set up as qualified opportunity zone businesses, we also set them up as 1202 businesses to give them the optionality on which incentive they're going to use at the end of the day. But I think, like I said, I think a lot of it's an education process, in that if you're going to start up a business and you're putting in relatively low capital, and you don't, particularly if you don't have much tangible property for your business, and even if you do and you're located in the right area, that if you're going to have an office that has desks and computers, and you're going to already, or you want the optionality to be in an opportunity zone, there's no reason you shouldn't do this, and structure your business this way. Because on the backside, let's say you have to invest $100,000 to start up your business, your small business, and you don't have much in the way of tangible assets. You're creating either a tech-based product or something that is a brokerage business or something of that nature. And after 10 years, if that $100,000 initial investment has become worth 10, $20 million, just imagine what your upside is if you don't have tax on that exit. It's incredible. So where we see this right now probably most often is startups. We see it in franchise type businesses. So you're creating a headquarters, and then your franchisees are not QOZBs, but you're leaking a lot of value through those franchise agreements, and all the IP is held at your headquarters, and that can be restaurants or fitness facilities or all sorts of different things. Sports franchises, buying a sports franchise into a qualified opportunity zone business makes a whole lot of sense, because your value is on a post 10-year horizon already. You're not usually buying a sports franchise for its cash flow off. It's for what that's going to be at the end of the day, worth. And so all those types of businesses make a lot of sense, and I think we're already seeing an uptick in that area, and that's just going to continue.
And what are the basic requirements for maintaining, QOZ status for within a business, within a zone?
Yep, that's a great question. To be a good qualified opportunity zone business, it's the same whether you're real estate or you're an operating business. It's just we look at it a little bit differently. Because if you're a real estate business, your most important test is called the tangible property test. And that means at least 70% of your tangible property is the good property for QOZ purposes. And there's a lot that goes behind that, but a lot of it means that you're either buying new equipment if it's a business in a zone, or you're developing new property, or you're substantially improving something that was already there. But tangible property test doesn't usually matter as much to operating businesses, unless you're buying a manufacturing plant or something of that nature that's already in existence, and we have to substantially improve it or buy a lot of new equipment. Typically for operating businesses, they pay more attention to the gross income test, which means at least 50% of your gross income has to be derived from an active trader business in an opportunity zone. And we helpfully have some very good safe harbors around that. The most helpful safe harbors are objective, and they provide that if at least 50% of your employees are contractors by hours logged or by wages attributable to their work or in an opportunity zone, either one of those tests, then you meet that gross income test. There's a third test, which is a headquarters test, which is a little bit more subjective, less objective, but that we have to rely on that one sometimes as well. But the good thing is we have those safe harbors. So while 50% of gross income in an opportunity zone sounds like it's up in the sky and it's hard to define, we have those safe harbors to get met. There's some other tests too, intangible property test, and probably importantly, the non-qualified financial property test, which means that we can't own lower tier entities unless they're disregarded for tax purposes. So what that means in practicality is we can't go buy a competitor and buy, say, 70% of a competitor. We have to buy 100% of the competitor, make them disregarded to us. And if we have to give them stock or or membership interest. We give them that in our current business. We don't let them keep their interest in their business. And so there's a lot of structuring that goes into that if we're going to be acquiring companies or creating a lot of lower tier entities.
Mhm.
Unfortunately, we're limited in this field to just having those two taxable entities, the Qualified Opportunity Fund and a Qualified Opportunity Zone business. Anything underneath the business has to be disregarded.
Interesting. And so somebody who has a small, like you said, brokerage or has a insurance company or whatever, with very few employees, as long as 50% of those employees and 50% of the revenue is generated within that zone, generally that's
It's
acceptable. That
Yeah,
qualifies.
absolutely. It's great for brokerages. It's great for insurance companies. It's great for property management companies in many cases. Hedge fund managers, as long as we can strike out their equity interest into a sidecar vehicle. Their fees can be taken here. So I mean, it's all sorts of businesses can qualify.
Right. Amazing. So it just makes sense if you are in an area that is a qualified opportunity zone, then you should consider opening a QOZB. There's really no downside as long as you're going to meet those minimum thresholds and meet those minimum requirements because you can attract very favorable capital that's going to get this preferential tax treatment that is going to make their returns a lot more interesting. Now it's longer term. They have to keep their capital in this business for a minimum of 10 years if they want to experience the full benefit, but they're already going to get a benefit after 5 years. And you're getting the deferrals. You're basically getting you're borrowing that money from the government at 0% interest, right? For the time that, those taxes that you would pay, essentially.
That's right. And now we have that rolling 5 years. So it's a 5 year loan essentially until you have to pay that tax. And I think importantly to your point, and this is just anecdotal, but I obviously deal with a lot of operating businesses, but I also, my friends will come to me and they might have started a hobby business, let's just say 5 years ago, and they actually started in a qualified opportunity zone. And now their hobby business has actually become a real business and they're selling it for 10, $20 million. And I asked them, why didn't you come and just ask me how you could put your first 25, $50,000 in it? And you would have been a qualified opportunity zone business and you wouldn't have paid that exit tax now that private equity is going to come and actually buy your business. And instead now they're going to have to pay the whole full tax on that acquisition. It's very powerful even if you're starting a very small business.
Interesting. Interesting. So I think also one of the criticisms about 1.0 and kind of the first opportunity zone round was that it was very focused on single asset properties, on the real estate side. Multifamily, industrial, didn't really address true mixed use, which is something that I think urban development really needs and has been lacking over, the recent history in terms of creating really interesting places that we call, demonstrate regenerative placemaking, like what we're doing in Jacksonville, the Phoenix Arts and Innovation District, what we have here at the Future of Cities Climate Innovation Hub, where all the businesses within the hub are QOZBs. And so and then the other critique I've heard is that, you talked about earlier creating jobs. Of course, creating the investment creates jobs, et cetera. But are they local jobs? And has it really helped revitalize these underserved communities? And so I'm curious to understand from your perspective, was there really guardrails to protect the vulnerable communities, the underserved communities, these low income areas? And, was it limited in terms of what asset classes people were guided towards or focused on, and how do you think that will change in 2.0?
No, that's a great question. And we honestly have seen the vast majority of investment has been in multifamily. And first of all, in real estate, then in real estate has been in multifamily. And
What percentage would you say is real estate versus businesses
I,
in
I'd say 75% has been real estate. And then
okay.
again, that's just based anecdotally on what we do, but I'd say about 75% has been real estate. And then I'd say in the real estate realm, particularly in recent years, has been multifamily. Early on, we saw every asset class, and we've seen some come back. We've seen hospitality come back. We've seen industrial got big, and industrial kind of has faded a little bit now. But we really and early on we saw office, Obviously, we're not seeing any office right now, but early on we saw a lot of office. But those are set classes. You're absolutely right. In big developments and big phase developments, developments that are truly mixed use, I think that there has to be more focus. And sometimes in my world, that means we're dividing that up into many different QOZBs, and you have different capital partners among those different. For example, your hotel JV partner is going to be different than your multifamily JV partner, and your retail partner might be different than everybody else. But we're seeing a lot of that in types of phase developments. Where I really think we're going to see some movement in this next round, and this is not the law today, but I think we're still pushing for this. And in fact, we might even have an executive order soon that addresses this, is affordable housing and workforce housing. We've seen a certain uptick in the workforce housing in the QOZ world, and lots of workforce housing inventory across the country come into QOZs. But I think if we could help reduce our substantial improvement requirement, which right now is 100%, and reduce that down to 20%, we will see a heck of a lot more workforce housing and affordable housing put on market. And I think that's still something that's possible. That's a bipartisan type of a push, because affordable housing is a bipartisan issue. It's something that two parties can't agree on very much. That's something that they do generally agree on.
We do need affordable housing. We have a shortage of how many million units of affordable housing? I think it's 7 million units in this country.
It's a lot.
It's a lot of units. And as someone who's developing affordable housing, we're in that as well. How do you marry the incentives from opportunity zones with the programs that we talked about, LIHTC, the HUD programs, the 4%, the 9%? What does that look like? What is the incentive stack, so to speak, that makes it so exciting? And why is lowering the basis requirement so beneficial that will help spark investment in workforce and affordable?
Well, I'm going to answer that last one first, because I think that's the most powerful answer. Is if we lower that, we're essentially you can buy stabilized assets under your qualified opportunity fund that are either rolling off their LIHTC, their low income housing tax credit compliance period, or that you can either keep affordable, which that would be, or you can turn market rate into affordable. You can buy market rate facilities and turn them into affordable facilities, and they would qualify here, and with only a 20% or less improvement or basis step up on those improvements that are already there. Today, you would have to put 100% in, and that's such a high threshold. Very few people are doing it. If you can make that 20% or less, now you're buying stabilized assets, you're putting an essentially value add into them, and you're either keeping affordable, or you're making market rate affordable and converting it, and you're doing it under a QOZ incentive. That's incredibly powerful. That can move the needle in these communities, and in fact, it can become a great, I don't want to say alternative, but it's complementary to LIHTC. LIHTC's limited. LIHTC's competitive. It's limited, as you very well know. You have to compete for LIHTC, and it only goes so far. Here, there would be no cap, and you could do this on any project anywhere that's in a qualified opportunity zone, and it could open an alternative method for workforce and affordable housing that's very powerful. Now, to your other questions, how do you mirror this with other incentive programs? We do it very often on low-income housing tax credit programs, where either the GP or the sponsor on the deal is investing through a qualified opportunity fund, or in a rarer sense, where the bank is investing through, or the bank or the tax equity investor is investing through a qualified opportunity fund. And there's some developers nationwide and in the state of Florida that use their own qualified opportunity fund to do the investments into their own QOZ deals, which are interesting. So that's in the LIHTC space. And then we also use it in new markets tax credits and historic rehabilitation tax credits and in renewable energy. And in fact, we've had a lot of groups since the OB3 Act reach out to us on how QOZ actually might be saving renewable energy projects, solar projects across the country, because those credits are going to go away now. Right. If that doesn't get fixed. Those are going to go away at this point. And now QOZ is actually becoming one of the methods that solar developers are looking at to make this work for them.
Right. Interesting how that kind of happened. They took the incentive away, and the the solar credits, and then it's going to be potentially recovered by op zones, like you talked about, which is really, I think the key here to solving these big problems is layering on these incentives. I think that that's really what's very important because, like you said, it could be a game changer for affordable if you don't have to build from scratch, you don't have to double your basis, and you can come in and you can convert market rate affordable, or you can keep affordable, because that's the problem. After the lures expire, after the restrictions expire, most people, there's no incentive for them to keep it affordable. So you went through all of this work, all of this investment, all of this effort, and I'm dealing with it. I've got an affordable, a low-income housing project for seniors, for low-income seniors. That's it's yeah, it's just for low-income seniors that is now expiring. And unless there's incentives to keep it, and retain those units, it doesn't make sense because otherwise it's restricted. So that would be something that if it was in an opportunity zone, then you're talking about, and it's in a rural area, and you can lower your step up requirements to 20%. Well, then you do, like you said, a light refresher, and then you do a renovation, but you're not required to put in an excessive amount of capital, and then it can make sense to keep all or a portion of it affordable. And I think that that's the key, because a lot of product that gets built affordable doesn't stay affordable. That's what people don't understand. So that's why the model is broken, right? Because we can't even retain the affordable housing that we have, that we spend all of this taxpayer money to build. And this is a way that we can then preserve and keep some of the affordable and convert some market rate to affordable, right? I think that's
Right. And with a QOZ incentive behind it, converting market rate to affordable is not out of the question, particularly if we're doing stretch affordable. When I say affordable, it's obviously lowercase a
right.
affordable. And I usually stretch that into workforce housing. So to 100 to 120% type of AMI standard. And if you're doing that, then you're certainly going to be converting some market rate into those types of standards, which somewhat will mirror your live local.
Right, exactly, which will also mirror live local. Okay, really fascinating. So this is very exciting potentially for affordable housing, solving those issues. Very exciting potentially for renewable energies when you talk about layering these incentives when you're coming off of LIHTC. Now let's talk about, so there is a gap between 1.0 and 2.0. There's all of 2026, basically, that you're not going to really get any benefit if you put it, you can't really put money of gains in 2026 and really get the benefit, because you're gonna have to pay the taxes in 2027. So what are people doing to bridge that gap? And what do you think is the likely scenario that is unfolding? Because I know you're working with a lot of clients
Yeah.
that are looking at bridging that.
Yeah, we're working on bridging it a lot. So we got a lot of groups that are bridging it, and there's a lot of different strategies around that. Some of that can be focused around how can you get into a 1031 deal today and get out of it in 2027. Some of it is focused around putting in short-term debt instruments. So whether that's internal, so investors themselves create the debt instruments, or you're creating true subscription lines with third parties. But uh, doing it through bridge debt, essentially, into the end of next year. And then some of the more complicated strategies all revolve around having intentional inclusion events at the end of next year. And an intentional inclusion event is where you are intentionally blowing up your existing qualified opportunity fund investment, which gives you, under the regulations, a 180-day period to invest in an existing or a new qualified opportunity fund, which very well might be in 2027. And in fact, that would be many investors' goals. So there's a lot of different strategies there, and they're all pretty complex. And so I can't really go into the details, but it's a very hot topic in the industry: is how can we raise money today, get 2027 benefits, and start deploying money today if you're a fund sponsor or a developer looking for the money today.
Interesting. And so you think any of that is going to be adjusted by the legislation? Any
Nah.
amendments, or is it pretty
Well, no,
much?
not necessarily these short-term strategies. These short-term strategies just all make sense under the law. They're part of the law itself. There's outgrowths of some of these strategies, particularly that last strategy I just talked to you about, that can actually be applicable every 5 years. Who knows if that could get closed in the future? It may be, who knows? But it's that could actually have application on a rolling 5-year basis, which can almost turn the QOZ incentive into something that's akin to 1031 investing.
Interesting. So now you're looking at potentially combining other incentives to get around this or to bridge, from 2026 when it expires to 2027, so that people can start raising capital now and be ready for projects then. Do you think this is going to have an impact on real estate transactions in 2026?
Absolutely, particularly the latter half of 2026. We're seeing my market prediction, just because of what we're seeing in here, is we're going to see a lot of funds launch in 2026. A lot of qualified opportunity funds. The big funds are probably going to launch a lot of them.
Second half of the year mostly, right?
I'd say first half. They're going to start capturing K1 gains from the very first part of that year using some of these bridging strategies that I was just alluding to. So I would say first half of the year, we're going to see a lot of funds launch. Then we're going to see a lot of deployment, a little bit in second half of 2026, and a heck of a lot in first half of 2027. And what the deployment in late 2026 or maybe even early 2026 is going to be into good QOZ 1.0 tracks that have those timelines associated with them and could be going away, so that investors want to get into those because they like that 1.0 track and they know it's not going to be there forever. And they want to get into those deals, the tail ends of those types of deals. And then when we start having the true 2.0 investors, which a lot of those funds that are raised in 2026 are going to be 2.0 funds, but they're going to be bridging strategies. But when the real 2.0 investors start coming in, they're going to invest in both 1.0 and 2.0 tracks. So and then 1.0 investors are going to be investing in 1.0 and 2.0 tracks and every type of mix and match in between. So it's going to be very interesting. It's going to be a very interesting 2 years there where we got an overlap.
And when do the new districts become designated? What is that?
So governors can start making those designations starting July 1st of next year through, if they use their extensions, they get through October 27th, I believe. It might be October 28th of next year. And then Treasury will certify them likely by the end of next year. So those will start almost immediately in 2027 as eligible for investment. And so it'll be a very political process, and a lot of advocacy is going to be going on with governors' offices starting now. We're already seeing it, but certainly leading up to July 1st and the designation period.
But we'll start seeing the bulk of that activity next year in 2020 and 2026, starting July 1.
Yes.
And we'll start knowing more then.
Yes.
Fascinating. What are you most excited about 2.0? Because I see you invigorate. It reminds me of, I was with Sergey Brin, one of the co-founders of Google, last year. And, he has largely been out of the office for a while, uninspired by, this incredible technology company that he created. And then he said, I'm so excited to go back into the office because AI is really revolutionizing the world. And I want to be a part of this. I want to be a leader in it, And so I kind of feel like I see you with that new energy with 2.0 because it became languished. This program started to fade off. People didn't know if it was going to have a second life or not. And so I'm curious to you, to hear from you, what is most exciting to you? Because you seem invigorated. You seem like you've got a lot on your plate again. I mean, you're always busy, but now, of course, this is a whole new level of activity and a complexity, frankly, which actually makes your job way more valuable, right? Because somebody's got to decipher all these crazy things.
Well, I think what I'm most excited about, and I'm probably talking with about my team too, because they're the ones that actually are I just come in here and talk with you, but they're the ones that get a lot done. But what I think we're most excited about is we got permanency now, and permanency means that this is now not only, I don't want to say institutional because that has a true meaning, and that's not the meaning I'm talking about. This now has become something that is a stabilized part of our code that both businesses and developers will be able to use forever. And I think what's exciting for people like you that were early adopters and many of our clients that were early adopters and ourselves that became leaders in this industry early on is once you're already at that point where you've now have a good track record and success record, the sky is the limit going forward. And moreover, because we're going to see so much good come out of this going forward because of where we are, I think we've got the opportunity to make a lot of these big changes that weren't necessarily an OB3, but that we still have the opportunity to do. And we can do those through future legislation. We can do it through regulations, and we can do it through executive order, some of them. And I think we see a lot of those opportunities to make this even better than it is today. But I think that we were given the huge foundation to go forward in this new act, and it's breathed new life into the industry. I can tell you that my day to day right now feels like it's 2018 all over again. It is about as packed as they could get.
Well, that is exciting. And I think it's exciting because for me as well as, it is a powerful tool for shifting capital towards making big changes and solving big problems, especially in underserved communities. And I think this whole piece around affordable and workforce combined and leveraged with other incentives is what it's going to take. And you're right. I've been in this now since 2018, and we do have a track record. And, I still feel like your level of understanding is at a whole nother level than mine, of course, because that's your language. But as a practitioner and somebody who's been in it, I feel like I really need to, translate to almost everybody that I speak to. There is a lot of education, particularly on the business side, the small. And I think that to me is also extremely exciting because, we've helped a lot of small businesses buy their own real estate, get out of, this spiraling gentrification situation where they're pushed out and they start, our friends from Plant the Future, they started paying $2,000 a month in Wynwood, and then the rent, 10 years later was $20,000 a month. It was 10x. They couldn't afford it. I said, you guys need to get an SBA loan, buy your own building. Well, now imagine you combine the investment of the business, and it could be a QOZB, with owning the real estate, and it really unlocks a lot of value. And I don't think people really understand that. So to me, that's what gets my juices flowing, and what gets me excited is we're going to be able to solve a lot of the affordability, and the workforce. We're going to be able to stimulate jobs within those districts, in those areas that need it most. And lowering the AMI, yes, it is going to make it, but it's going to make it more limited and less districts, like you said, but it is going to impact the people who need it most, excluding the really rural areas. And maybe they'll, amend that in the future to try to address that, because I think that was an unintended result of
It-
something that was good intention.
that nobody really intended us to lose tracks. There's a long story behind that and how that all happened. But it did happen. So it's unfortunate it did. But having said that, and this is taking my business hat off and yours off too. It's not terribly, it's not a terrible thing if we lose some of the tracks that are the low hanging fruit for bad press in this industry. The ones that really didn't need QOZ. That's not a bad thing. I never want to see a reduction in census tracts for the QOZ incentive, and I don't think that was a positive here. But it's not a bad thing for us to lose areas that could have given or might have given the industry bad headline risk. And I don't think we're going to see that in 2.0.
Right. I guess my one last thing, when we talk about rural areas, I often think about agriculture, and I often think about conservation. I think about, land that maybe should not be developed. So really rural areas. How does conservation agriculture, in your mind, play into, and bioregional planning play into QOZB's 2.0? Because to me, that's very fascinating in terms of what I'm looking at in the projects that I'm doing in Central.
No, I think ag and ag related businesses are going to be very big in this next going forward. And it's not even next round. We're now permanent, but
Yeah.
but I think they're going to become very big. The challenges with them is you have to meet the substantial improvement test still. So it's just not buying stabilized farmland and making a QOZ. There has to be enough substantial improvement to that, and we have to meet what that's been outlined in the regulations. But if we can do that, then absolutely. For example, we've already seen a lot of activity in, say, slaughterhouses around the country being located in QOZs. And anything where you've got a lot of capital spend to make that agricultural development, whether it's crops or whether it's animals, then I think it's going to work very well. Where it's not going to work well is just taking over an existing agricultural operation that doesn't have much capital expenditure to do.
Right. All right, Jim, I think our time is up. This was extremely insightful, very informative, inspiring. And I hope everybody who's listening really got something out of it, because I certainly did. Every time I speak to you, it, gets my synapses firing, gets me thinking about the unlimited possibilities and the amount of creativity that can be created through opportunity zones and the opportunity for growth and revitalization in the most vulnerable, underserved communities. So it's very exciting to see like where we are 5, 10 years from now and what the world looks like from programs like this, which, really is going to attract a lot of capital, as you said, and you feel the pulse. So, I mean, people, on the street may not know that, people, that are not in the industry, but like you said, this is like 2018 all over again. It's like a revitalization of this program. So where the capital flows, that's where growth grows. Like that's where it's going to happen. So there will be a lot of capital that's flowing into these areas. So it's now our responsibility to understand what that means and how to steward it in a responsible way, which is what we at Future of Cities is really focused on doing. So I'm really excited to see how we can leverage this amazing program to really help revitalize, both rural and urban areas, which we're going to see in the next phase, and to help small businesses. I think that that's really something that we're going to see in this next phase, and anything that we can do to help educate the small businesses out there how to take advantage of these incentives and others is really going to help stimulate our local economy.
Well, and that's the purpose here. That's absolutely the purpose, is grow jobs and get us the right housing.
Exactly. Well, you heard it here first with Jim Lang, and I'm Tony Cho from Future of Cities, and this was a special feature on Opportunity Zones 2.0, and I look forward to talking to you again, Jim, in the near future. Come visit us back in Miami, and we hope to see you soon.
Sounds great. Thank you, Tony.
Thank you.